Welcome to our conversation on financial reporting. The focus of this session is to understand the IPO information, the issue price, the book value per share of some of the new age companies. And when we say IPO or a public offer, it can be offer for sale or fresh issue. The offer for sale is the issue of shares in the form of a divestment by some of the existing promoters of the company, and they try to monetize their investment. The offer for sale will not affect the balance sheet of the company. Whereas the fresh issue, there is an issue of new shares and there will be an inflow of cash. And most of the cases, the public offers will be a combination of offer for sale and fresh issue. But one of the important things that we would like to focus our attention whenever we observe the public offer is this concept of book value per share. The book value per share is a financial metric that represents the equity available to the common shareholders divided by the number of the common shares. It shows the equity per share. So book value per share is equal to total equity by number of outstanding shares. But we know that equity is also equal to assets minus liability. Therefore, this is book value per share is an asset backup per share. And it's important for us to observe the change in the book value per share. And the book value per share can change if there is an issue of shares, if there is a cash dividend, if the company goes for a stock dividend or a bonus issue, or if the company goes for a rights issue, in case there is a stock split or buyback of shares. And all these are important decisions. And all these decisions will have an impact on the book value per share. Therefore, it is important for us to observe the book value per share and understand the things that are happening within the company. They often say that price per share is a function of the book value per share. So by observing the book value per share, we can also understand what is happening within the company. Now, let us observe what happened in 2024. Some of the interesting IPOs, several IPOs happened, but the focus here will be of new age tech startups. A total of 30 new age tech startups completed IPOs in 2024. And collectively, they raised 29,000 crore. And most of these, is important to remember that most of these have also listed above their issue price. So they gave a significantly good return to the people who have actually invested in this company. Some of the common and popular startups are Ola Electric, Swiggy, Office, Unicommerce, and Tech Infosys. And we will pick up one or two to understand the book value per share, they understand the issue price, and what happened to the number of shares before and after. Ola Electric Mobility Limited is one such example. In 2017, it was established as a wholly owned subsidiary of ANI Technologies, which is Ola Cabs, and aimed at pushing the electric mobility via pilot in Nagpur, including the electric cabs and charging infrastructure. So they took a first step in towards the EV. And late 2018 or 19, it was spin-off, and from Ola Cabs, when one of the founders bought about 92.5 majority stake in that company. So Ola Electric Mobility was once a subsidiary and it just came out of the company Ola Cabs. The fresh issue of shares, this particular issue, the face value per share was 10 and issue price was between 72 to 76. It's a book building exercise. The final price was 76. And you can see that when the listing happened, listing happened at 91.45 per share. And this excess of money, 76 over 10, is the security premium. So face value is 10, issue price is 76, and 66 is the security premium. So on the balance sheet, 10 will be shown in the share capital, and 66 will become a part of the other equity under security premium. You may ask the question, what will be the effect of 91.45 on the balance sheet? No effect, because it is a market price. The balance sheet of a company is not affected by this directly. And so pre-IPO, the number of outstanding shares were 3,687.07 million shares. 3,687 million shares. And this issue of Ola partly was a fresh issue and partly was the offer for sale. We can see that. The issue was partly for fresh issue and partly. The fresh issue was 72.38 crore. And the offer for sale was 8.49 crore shares. So the money collected through this fresh issue will affect the balance sheet of the company. The cash flows will be getting into the company. But whereas 8.49 crore OFS will not affect the balance sheet of the company. And most of the companies, whenever they go for fresh issue, they always also make a reservation for some of the employees. And here also, the company reserved a small portion of the shares as the employees' reservation, and which was at a discount of ₹7 to the issue price, just to encourage the employees to buy the share. Now, what is the effect of this fresh issue and offer for sale on the company's balance sheet? As we already said, the number of shares have gone up. The number of shares, increase in the number of shares, is because of the fresh issue, not because of the offer for sale. We can see that. Post-IPO share is a pre-IPO shares plus fresh issue. So the post-IPO share, 4,410 million share, is equal to 3,600 million plus 723, okay, which is a fresh issue. So the offer for sale is a transaction between two shareholders. This is a transaction between two shareholders. Now, because of the issue of shares at a premium of 66, because the number of shares have gone up, the book value per share will also change. Pre-issue, the book value of share was 5.5 rupees per share, equity available. But since the price at which the shares were sold was way above this book value, is in the sold as 76. So the post-issues book value has gone up to 17.05. So the increase in the book value in this case is solely because of the issue of shares at a premium. But later on, when you see the latest annual reports after the performance of the company, so the book value per share may once again change because of the current PAT, current dividend, and many other decisions. And what is the company planning to do with this money, the money which they have raised through this public issue? So the prospectus has very clearly said that this 5,500 crore were used for CapEx, expanding the capital expenditure on the Ola Gigafactory, rupees 8,800 crores for debt repayment. So 1,200 crore for creation of assets, 800 crore for reduction of liability, 1,600 crore toward the research and development and product development, 350 crore for the business expansion initiatives. And the rest, whatever small amount, is for day-to-day. So the money raised by the company was partly for capex, partly for loan reduction, and partly for a significant amount for the R&D development. Now let us see another interesting company. So that is Office Space Solution. It was founded in 2015 by Amit Ramani, and it is a New Delhi-based company. And Office Space Solution has rapidly evolved into India's largest providers of flexible workspace solution. But they have a very interesting strategy of an asset-light strategy, where the property owners contribute 50 to 90% of the fit-out costs. That means the capex is not spent by the company. They're tied up with several property owners. In the process, an income-generating activity was also created for the property. And around 60 to 70% of the seats are under this model, under this asset-light strategy. So the company wants to leverage the idle fixed asset, idle property available in the cities and the tier 1 and tier 2 towns. And as of 2023 mid, Office operates in about 16 cities across India and having 140,000 seats. And it's a tech-enabled platform. It's app to enable bookings of seats, rooms, meeting rooms, amenities. They extensively use AI, ML, facial recognition software. So it's a highly tech-oriented company too. Now, like Ola, the Office Space also was a combination of fresh issue and offer for sale. 0.033 crore fresh issue of 128.06 crore rupees, and offer for sale was 1.23 crore, aggregating to 470 crore. So there was a big amount of offer for sale, maybe to monetize the initial investment. And like Ola Electric also, here also the company reserved a portion of the shares for the employees, and that too at a discount to the issue price. This is a conventional practice to encourage employees, to motivate employees to buy the shares and continue to operate with the company. So as a result, we can see that the number of shares have gone up. The increase in the number of shares is because of the fresh issue. This will not increase the number of shares. This is a divestment of shares by the individual initial investors. So increase in the shares after the issue is because of the fresh issue. And because of this, just like Ola Electric, the book value per share has also gone up. The book value per share has gone up because of the issue of shares at a premium. We can see that the 3.3 million new shares were issued at 383 per share. Face value is 10. So the premium is 373, a big premium, unlike the Ola Electric. Therefore, the book value per share has increased from 39 to 54. So increase in the book value is because the shares have been issued at a premium. This difference, 373 added to the security premium, which appears in the statement of changes in equity under the share premium. And this increases the total equity of the company. The offer for sale will not affect the equity because it's a transaction between existing shareholders. So we can observe that the company Office Private Office raised this money to a large extent for offer for sale, and the amount, the balance money which was raised as a fresh issue was used for capital expenditure to new centers, around 42 crores. Day-to-day working capital requirement, 54 crores, and technology development, 15 crore, and some general corporate office expenses. So we are able to see that most of these companies whenever the startups, whenever they go for the public issue, in the initial stages, it's a combination of fresh issue and the offer for sale. And in most of the cases, the book value per share rises, whether it is office or it is Ola. We are able to see that the book value per share goes up. So we are able to understand that the companies go to the market to raise money for capex or reduction of liabilities, or sometime to meet the day-to-day expenses. And the other reason is some of the shareholders, the initial investor, also use the opportunity to divest their stake. Thank you very much.